Bloomberg Audio Studios. Podcasts, radio, news.
The Stock Movers Podcast, your roundup of companies making moves in the stock market, harnessing the power of Bloomberg data.
I'm Carol Massar along with Tim Stanovic. So let's get to some stocks on the move. First up, we want to talk about Coca-Cola, which said it plans to launch a new Coke product for American consumers, Tim, made with U.S. cane sugar this fall. It's something the administration kind of wanted them to do.
Bloomberg Intelligence senior analyst for consumer products, Ken Shea, joins us from New Jersey on Coca-Cola. Ken, we spoke to you last week. July 17th, you joined us. You also had a note out that said Coca-Cola was unlikely to move completely to cane sugar. I should say you were absolutely right about that. They are not getting rid of high fructose corn syrup. It sounds like what they're doing is coming out with a new cane sugar version of Coca-Cola. What can you tell us?
Yeah, hi, Tim. Well, as we expected, and fully in sync with what Coca-Cola has been saying all along, and that is it wants to be a full beverage company. So if there's a demand for a niche or a segment of the market that it feels it can play in there economically, it's going to do it. And so the cane sugar product extension, really, of the brand Coca-Cola is no exception. We already know there's a demand for it. Lots of consumers like the Mexican Coke, they call it, gets imported into the U.S. in some selected markets. There's actually some small competitors that use it. Only small competitors because it's a more expensive version of a sugary drink. High fructose corn syrup is much less expensive. But I think Coke is really smart in bringing this out, not only because it appeases the president, but also because it is a niche product. Coke likes to play in different niches to see what can work and what might not, but it's willing to take a chance. And it's one of a few innovations that it has in store for the second half that I think investors are embracing here.
Wait, forgive me. This is an innovation? Just switching the sugar? And it already makes it, as I know, it's something Tim likes and my husband loves because he'll order it like the Mexican Coke.
Comes in glass, too, which is awesome.
Exactly.
So maybe that's why it tastes good.
Help me understand, because innovation to me is something new and different.
Okay, so maybe it is not a full-blown innovation, but it's certainly a product that isn't mainstream. Let me put it that way in the U.S. High fructose corn syrup versions of sugary drinks, Coca-Cola, have been really the mainstay primary version since the 1980s, just because it's less expensive. Most consumers don't know the difference. Some aficionados of soft drinks certainly do. And so I think it's going to be more of a niche product, maybe not an innovation. Maybe that's a little stretch, but we'll see how they brand it in terms of it's certainly going to be a premium price product if for no other reason to cover the cost. But I think it's going to be sold, in some markets like I said, at a premium price, not all their channels. Most of the channels, though.
How much more expensive is cane sugar from the U.S. versus high fructose corn syrup?
I would estimate about twice the cost on a per unit basis. That's a rough rule of thumb, but that's generally the way analysts look at it. And like I said, they've shied away from it. There hasn't been a high clamoring for it until recently. And so they're going to have some fun with it, too. They're going to come out with this, and they're going to see where it takes them. It's one of a few innovations, though, and maybe not innovation, but a trend, I should say, of the protein drinks. Again, not a new innovation, but it's suddenly taken off because of consumers are recognizing that it's a great way to have a post-recovery for the GLP-1 drug users. It's a great way to replenish maybe lost protein with the weight loss. There's been a recovery in sports drinks. So these are all areas where Coke's going to invest heavily in the second half to try to keep the growth engine going.
The business, just to tie it up here, the business at Coke they're massive still, right? They are a big player in the global beverage market, but their business overall, how would you describe it?
I would say today reinforced it's right on track. They pretty much reiterated their growth expectations for the year. Their long-term growth algorithm, as they call it, is for 4 to 6% organic revenue growth annually, and they still see 5 to 6 for the year. So it's right on track. With that and a little earnings leverage, they can try to get to mid to high single-digit EPS growth over the longer term. I think investors are pretty much reassured. I would say solid results.
Yeah. All right. Really appreciate it. And shares of Coca-Cola, we should point out, they're up around 12% year to date. Hey, Ken, thank you so much. Ken Shea, Bloomberg Intelligence Senior Analyst for Consumer Products, joining us in New Jersey.
Does it actually taste better?
I'm not a soda drinker. Except for ginger ale when my tummy doesn't feel
The only way for us
good.
to figure it out, blind taste test. We'll do it.
Let's do it.
Yeah.
All right. So let's go from one iconic brand to another.
Yeah, let's talk a little bit about what happened with General Motors. Profit fell as the company said it suffered a $1.1 billion profit hit from President Trump's tariffs. It revealed no plan for a near-term fix to return to pre-tariff profit levels. David Welch is in our Detroit News Bureau. He joins us from Detroit. He's been covering this company for years. The headline we're all talking about is that $1.1 billion hit. Break it down for us. How exactly did this end up hitting GM so hard?
No, they have a lot of exposure because close to half of the vehicles that they sell in the U.S. are imported. So they're paying a lot in tariffs. There are things that they're going to do to try to mitigate those costs, but they're in the early days of doing that. So you didn't see the impact of that stuff in the second quarter. And even if all of it had come to fruition in the current quarter or in the previous quarter, it would only offset a third of that. So there's a long walk to get to the pre-tax profitability that the company had. And to do that, they're going to have to relocate production of some vehicles, some parts in the U.S. They announced a $4 billion investment, which will do some of that, particularly with vehicles in Mexico. But they still import vehicles from Korea. They're waiting on a trade deal there. It's one of their top sellers, the Chevy Trax. They sell 200,000 of them a year, and it's getting hit with a big tariff on South Korea. So, these are not easy things to deal with. There is no quick fix for it, and you can't just pass the cost on to consumers because they're already paying very high monthly payments because car prices are very high and so are interest rates. So there's no real way out of that. And they had some other operational issues that had nothing to do with tariffs that also hurt their profits in the quarter. All in, it wasn't like it was a terrible quarter without the tariffs, but it wasn't a great one either, and there's no easy way around that.
$1 billion on its own sounds like a lot. $1 billion hit, it's not something a company wants. Is it big in the grand scheme of General Motors?
No, it is. I mean, they're going to see exposure this year from tariffs of $4 to $5 billion.
Okay.
And like I said, they'll offset some of that, but that's a lot here. And so, to put it in perspective, their EBIT, the operating profit for the North American business alone, was $4.4 billion last year, $2.4 billion this year. So, and that's their big profit generator, is that North American business. So half of that hit was tariffs, and there were other things like warranty costs, like building up inventory for electric vehicles, which they're selling more of and trying to really grow as a business. But those vehicles lose money. That's another area that actually hurt profits for them. But that took their EBIT down by 25% in the quarter alone, the tariff hit. So it is a very big deal, and it's something that they just can't easily rectify.
Well, on the rectifying this, David, somebody from the Trump administration, if they were sitting here, might push back and say this is exactly why we have this policy in effect. So the work that is done outside of the U.S. by workers who are not American will be moved to the United States and will then in turn be done by American workers. Is that realistic?
Well, they are going to get some of it back. Look, GM announced a big investment in the U.S., and it's worth 3,000 or 4,000 jobs, making pickup trucks and small Chevy Equinox SUVs that are made in Mexico. They'll still make some there, but they're going to make a lot of them here in the U.S. too, and also probably will take some production away from a pickup truck plant in Canada as well. So it is bringing jobs back. And the other argument the Trump administration would probably make is GM's not raising prices because it's not really clear that they can get a lot of pricing out of consumers. So really, the Trump administration is taxing GM, not taxpayers, not consumers, with these tariffs. So they would say, hey, it's not been going to be this inflationary thing that the critics said, and it's going to raise money for the federal government, and it's just going to hurt somebody's profits and disappoint some Wall Street analysts and investors. So that's the other side of this. And I think that's going to be the case with all the automakers going forward for the next couple of years.
Hey, listen, anything on the call or any questions that are still, you feel like, not completely answered in your mind or in the minds of investors as you reported this story out?
There is an open question about raising prices on vehicles. There's no way they could recoup all of the tariffs by passing those costs on to consumers. It's just too much money. Mm-hmm. But we have seen other car companies sneak in little price hikes here and there. Does GM start to do that at some point? Right now they're saying they're holding the line and they're not going to do it. But that is what we're really watching with GM and all of its competitors in the next 6 months, is what happens as we get trade deals. There will still be higher tariffs. What happens with pricing going forward?
The Stock Movers Podcast from Bloomberg Radio. Check back with us throughout the day for the latest roundup of companies making news on Wall Street. And for the latest market-moving headlines, listen to Bloomberg Radio live. Catch us on YouTube, Bloomberg.com, and on Apple CarPlay and Android Auto with the Bloomberg Business app.